Kroger is one of the largest grocery brands in the United States, and it's one of the stocks Warren Buffett holds in the Berkshire Hathaway portfolio. Kroger does over $140 billion in revenue annually, and just recently reported their second quarter earnings results. The stock saw a huge boost after the company reported its earnings, but has since sold back down with the overall market so far this week. The business has also grown its dividend per share at a compounded annual growth rate of 14% over the past decade, which means that if you were buying this stock in 2012, your dividend yield on cost would now be over 8%. It's a very boring business that generates a ton of cash for its shareholders, and it's seeing a boost to its sales from inflation. Over the past decade, it has also outperformed the SPY, while paying a higher dividend at the same time. So the returns this business has generated for its shareholders speak for themselves. In today's video, we are going to be going over Kroger stock to see if it is presenting an opportunity for long-term dividend growth investors. There are also some surprising things about this business that you may have never heard before. So this is going to be a very educational video for you if you are interested in improving your own investing. With that being said, let's just hop right into the video and let's head over to Kroger stock here on Stock Unlock. And the first thing we're going to do is head over to our Stock Unlock Insights to see what we have to say about the stock. Now, right away, we can see that Kroger has a dividend score of 4.7 out of 5, which is very good. The forward dividend yield right now of 2.1% is slightly above the 5-year average. However, the dividend per share is increasing over the past year, and over the past 5 years, the dividend per share has increased by about 12%. The payout ratios are very low, and the free cash flow payout ratio is decreasing. So the dividend looks like it is very healthy, and it is growing at a strong growth rate of 11% over the past 5 years. If we scroll down, the company's profitability score is a 2.8 out of 5, and this is pretty average for a company in the grocery sector. The gross margin is about 22%, which is average, but the operating margin, net margin, and free cash flow margin are all very low at about 1 to 3%, which is not very good, honestly. But the cash conversion is over 100%, so all of the company's net income is actual cash flow for the business, which is very good. Now, if we move on to the growth, it is a 3.8 out of 5. The revenue is increasing by about 7% year over year. Net income and free cash flow increased by over 30%, which is very good. And the book value and tangible book value is growing, but just marginally. So overall, it does look like the business is growing in basically every aspect that investors care about. And it is nice to see the revenue, net income, and free cash flow growing in this economic environment that we are in. Now, if we move on to the financial health, it is a 3.5 out of 5. The current ratio is below 1, so that is bad. What this means is that the company has less current assets than current liabilities. So to pay off its liabilities that are due within the next year, it's going to have to use some of its free cash flow that it generates over the next year. That is what this ratio is essentially telling us. Next, we have intangible assets as a percent of total assets. It's very low. It's only 8%, so that is good. And the shares have decreased by 3.6% over the past year. So on top of the dividends that Kroger is paying, it's also buying back a large amount of shares. And again, it's decreased its share count by about 3.6% over the past year. The debt to EBITDA ratio is also 1.94, which is average. So in terms of how much debt the company has relative to its EBITDA, it's not that bad. Now, if we take a look at the returns, it's a 4.0 out of 5. The ROIC is good at 17%. ROCE is good at 13%, and return on equity is about 23%. So this company is investing its cash within the business to produce quite high returns for shareholders. A 17% ROIC is actually pretty good. When I take a look at Kroger, I see a company that does not have very high profit margins. It is still growing, which is good, especially in this time of inflation. Its financial health is decent. It's got good returns. And it's honestly a very strong dividend stock. The dividend is growing very well. The payout ratios are low, and the payout ratios are even decreasing. So yeah, it looks like a really, really solid dividend growth stock just by taking a look here at our Stock Unlock Insights. Now, if we head over to the company's financials and we take a look at the trailing 12 months revenue, we can see that the revenue is at an all-time high right now as of the company's last reporting. And if we scroll all the way out to 2002, you guys can see for yourself that Kroger's revenue has just been consistently growing over the past 2 decades. Now, if we take a look at the gross profits, this is a little bit of a different story. So the company's revenue is growing and it's reaching all-time highs, right? But take a look at the gross profits, because the gross profits are kind of stagnating. And I think that this is because the company's cost of revenue is increasing with the overall revenue due to the high inflationary environment that we are in. A lot of companies' expenses are increasing right now, especially their cost of revenue, because gas prices are higher and just the input cost to make product is higher right now. However, take a look at this because Kroger's operating expenses have been declining since the first quarter of 2021. So while their cost of revenue is going up and their gross profit is remaining the same, their operating expenses are declining. And what this is leading to is Kroger's operating income hitting record highs. In the trailing 12 months, their operating income has now been $4.2 billion. So the company right now is focused on increasing its operating efficiency and increasing its operating margin, and it is doing so. So let's head over to the company's cash flow statement. And if we take a look at the operating cash flow, it isn't actually at an all-time high. But in the trailing 12 months, they still produced about $5 billion of operating cash flow. Now, if we scroll down to the company's free cash flow, it's not at an all-time high either. And in the past year, they have generated about $2.5 billion in free cash flow. The overall trend for the free cash flow is growing and it is going up. But again, the free cash flow is just not at record highs right now. So that is definitely something to note. Take a look at this right here because this is very interesting on the cash flow statement. So in the past year, in the trailing 12 months, they have paid out $605 million in dividends, okay? And we can see that the dividend payments are clearly growing over time, so the company's dividend per share is growing over time. However, take a look at this. Their net common stock issued was negative 1.6 billion, 1.7 billion if we want to round up. When this number is negative, it means that the company is buying back shares and not diluting. So they have spent about $1.7 billion on share buybacks over the past year and only paid out about $600 million in dividends. Kroger is much more focused on buying back shares than actually paying out dividends. I mean, take a look at this. They did about $2.5 billion in free cash flow in the past year, and they spent about $2.3 billion on dividends paid and repurchasing shares. So almost 100% of the company's free cash flow is going back to shareholders, and the majority is going back to shareholders through stock buybacks. If we head over to Stock Unlock's freeform tool right here, and we take a look at Kroger, what we're going to do is we're going to take a look at the dividends paid and the net common stock issuance, and we're going to zoom out to about 2012 here. Okay, so what we can see right here, take a look at 2018, because in 2018, Kroger paid out about $442 million of dividends, okay? But in that same year, they repurchased about $2.6 billion of shares. So they repurchased about 7 times more in terms of total dollar amount than they paid out in dividends. And again, in the trailing 12 months, they've paid out about $605 million in dividends, but the net common stock issued or the buybacks has been about $1.6 billion. So taking a look at Kroger's history, again, it looks like the company is more focused on buying back shares than it is paying dividends. So now what we can do is actually take a look at Kroger's shares outstanding over the past decade. And right here, we can see that the shares outstanding have declined at a compounded annual growth rate of 4.3% over the past decade, which essentially means that on an annual basis, on average, Kroger is buying back about 4% of its shares every single year. Over the past 20 years, the company has repurchased on average 3.7 or 3.8% of its shares every single year. So they have just been consistently buying back shares. Now, what's also interesting is in 2002, the company had 1.5 billion shares outstanding, okay? 1.6 billion if we want to round up, actually. And today, the company now has only 720 million shares outstanding. Through all of the buybacks that they have done over the past 20 years, their outstanding share count is now less than half of what it was 20 years ago. That is how much shares they are buying back. That is a ridiculous amount of shares that they're buying back every single year. And what's interesting about this is if we take a look at Kroger's free cash flow versus its free cash flow per share, and we scroll down to our quick stats here, we can see that over the past 20 years, the free cash flow has grown at a compounded annual growth rate of 5.3%, but the free cash flow per share has grown at a compounded annual growth rate of 9.5%. This is once again because Kroger is buying back so many shares, and as it reduces its share count, the free cash flow per share increases at a faster rate than the overall free cash flow. And this leads the stock to produce returns at a faster rate than the company's overall free cash flow growth. Right here, we can see that Kroger's stock price over the past 20 years has grown at a compounded annual growth rate of 8.2%, and that is much higher than the free cash flow, once again, because the free cash flow per share is growing faster than the overall free cash flow, which is allowing the stock price to appreciate at a faster rate than the company's free cash flow can grow. So that is why stock buybacks are so beneficial to shareholders. And that's probably why Kroger is so focused on simply buying back as many shares as they possibly can. Now, also, what I want to show you all is Kroger's percent returned to shareholders. And right here, we can see that in the trailing 12 months, Kroger has now returned about 6.3% to shareholders. And this number factors in these stock buybacks with the dividend per share payout. And right here, we can see that in 2018, when Kroger was buying back like $2.6 billion worth of stock, the percent return to shareholders got all the way up to 15.4%. This is what I mean. On top of the dividend, Kroger is buying back so many shares, and when you factor that in, the actual amount that they're returning to shareholders is quite significant, again at 6.4% in the trailing 12 months. So it looks like this business's fundamentals are growing. The operating income is growing, operating cash flow isn't at an all-time high, but revenue is at an all-time high, and the company is returning a ton of cash back to shareholders. So what we're going to do is take a look now at Kroger's price to free cash flow. How expensive is this business actually? And when we zoom out to 2012 and we take a look at the past decade, we can see that Kroger's price to free cash flow has been quite volatile. I mean, back here in 2017, the price to free cash flow got all the way up to like 56. It then fell all the way down to 13 at the end of 2017. And then in 2018, it got back up to 40 and then 44. And then it fell all the way down to 6 in 2020. So when I take a look at this metric right here, it tells me that it's pretty inconsistent and it's just very volatile. So it's going to be hard to get an accurate representation of how the company is being valued versus its history when the number is so volatile. So instead, I'm going to take a look at the price to operating cash flow. And right away on this chart, we can see that the price to operating cash flow is much less volatile and it's ultimately a lot more consistent. So I'm going to use the price to operating cash flow to value this business and see if it is expensive versus its history. Kroger is selling for a price to operating cash flow of about 7. Now, over the past decade, the average has been basically 6 on the dot. So the company is selling slightly above its historical average in terms of price to operating cash flow. And we can see that back here in like 2017, it was selling for 4. And then in 2020, it was selling for 4 once again. So it does look like the stock is on the higher end of its price ranges, at least in my own opinion, and it does look like it is on the more expensive end relative to how it has been valued throughout history. Now also, Kroger put out this screenshot right here, or sorry, they put out this slide and then I took a screenshot of it because they raised their guidance on their Q2 financial reporting. They raised their full year guidance, and this is why the stock responded so positively to their earnings. So right here, they say that they're now expecting free cash flow to be about $2.4 billion for the year of 2022. They're also expecting their operating profit to be higher and their EPS to be higher. But the number I care about is free cash flow. And we can see that their CapEx is also projected to be about $3.5 billion, which tells us that the company is most likely projecting to do about $6 billion in operating cash flow for the year of 2022. Now, we can see that in the trailing 12 months, the company did $5 billion of operating cash flow. So they are expecting their operating cash flow to actually increase throughout the duration of the year. And if they're going to do about $6 billion in operating cash flow this year, and they're selling for a market cap of $35 billion right now, then we can take $35 billion and divide it by 6. And this gives us a forward price to operating cash flow of about 5.83. And that does lower Kroger's price to operating cash flow below its average over the past 10 years. So if the company can actually hit those projections and do that $6 billion in operating cash flow this year, then the stock potentially could be selling for about its average historical price to operating cash flow, which means that it could be selling about at fair value. The last thing we're going to do, however, is go over to our discounted cash flow calculator, and we're going to play around with some numbers here with Kroger. And basically what we're going to do is go over to the operating cash flow, and let's say that they're going to grow the operating cash flow at 7% a year over the next decade, which is how fast it's grown over the historical decade. So essentially what we're going to do is just say that Kroger is going to grow over the next 10 years at the same pace as it has over the past 10 years. We're also going to say that it's going to buy back about 3.5% of its shares annually, and it's going to trade at that 6 price to operating cash flow. And when we enter any of these numbers, we get a discounted fair value of the stock of about 45.60 cents, or down about 7% from where the stock is currently trading. And this is what I mean. The stock is currently trading at higher priced operating cash flows. Yes, by the end of this year, the priced operating cash flow is going to drop down because operating cash flow is projected to grow. But still, right now, the stock does look like it is a little bit expensive. And if it does come down about 6 to 7%, then it will be selling a lot closer to fair value. But ultimately, Kroger looks like a very stable stock that is just growing over the decades. It's beating the S&P 500. It's an incredibly boring business. It pays about a 2% dividend yield right now, and it buys back a ton of shares. It looks like a very solid stock for the long term and a very solid dividend growth stock. Again, if you were buying this stock back in 2012, then you now have a dividend yield on cost of over 8%, which is pretty significant. But I do just think that it is a little bit on the higher end right now, and I would definitely be watching the stock if it does fall down a few dollars or about 6 to 7% and get more in that fair value range. So this is a very interesting stock. I definitely think you all should add it to your watch list, maybe do some more research, and yeah, see if the stock can come down and maybe get to that fair value target. But if you guys enjoyed this video, please remember to leave a like on it. And also, if you are interested in stock on a lock, then you can get a 14-day free trial by hitting the link at the top of the description. All you need is your email. You don't need a credit card or anything, and you can get access to stock on a lock and come and play around with our investment platform right here. Also, if you are interested in stock market related content like this and stock analysis, then make sure you subscribe to our channel as well, because we do a lot of stock analysis here and show you how you can do your own so that you can become a better long-term fundamental investor. Ultimately, that is our mission. So I really hope you guys enjoyed the video. Please remember to leave a like on it and subscribe to the channel if you want to stick around. But with that being said, thank you again so much for watching, and I really hope to see you all again in our next video.